buy. Sell, sell, sell. That may be all you know about the stock market. Buy low, sell high. After all, it doesn't look like much more than chaos. But you don't need to stand in this room to figure out the stock market. Stocks are basically part ownership of a company. You own stock, you own a stake of a business. Buying stock is a time-tested way to increase your money. But you have to be ready for what could be a wild ride and stay in for the long haul. The stock market can be volatile.
Stock prices often go up and down. They fluctuate based off of individuals' buys and sells. This happens daily. It's important to keep in mind that even though stock prices drop, not to get worried. Statistically, over the long haul, stock prices have been shown to rebound.
Time is definitely your friend when it comes to stock investing. And knowing that one can weather the storms of volatility in the market of a given stock is important. But over time, the stock market returns have indeed been better than returns on most other investments.
Investors need to recognize the volatility that is inherent in the stock market. In the aggregate, we do know that over the last 100 years, the stock market has moved higher. However, what you may not be aware of is that there have been extended periods of time where the stock market has moved sideways to lower.
You can increase your investment a couple of ways when you buy stock. One is through dividends, when the company makes a profit and disperses some of it to stockholders. This may be in money or it may be in more stock. Keep in mind, not all stocks pay dividends. The company may decide to hang on to its profits and reinvest rather than share them. 2, you might make a profit when you decide to sell the stock. You've heard buy low, sell high. This is where that applies. Money you earn here is called capital gains. That is, if you sell higher than you paid. Capital loss is the term for taking a hit on the price.
It's important not to risk everything you have in investing because there's always that risk of losing. If you invest everything, you lose everything. And it's important to have some savings saved up in the event of an emergency.
You don't want to put yourself in a position where you're forced to sell stocks into a downturn simply to meet your immediate obligations.
Buying and selling stocks is known as trading on the stock market. And there's more than one stock market. There's the New York Stock Exchange and the NASDAQ, or National Association of Securities Dealers Automated Quotations. From overseas, you'll hear about the London Stock Exchange and the Tokyo Stock Exchange. The daily ups and downs of all these markets are studied closely by investors looking for clues about how the economy is doing. But the one most often used clue is the Dow Jones Industrial Average. This one number is the average price of a group of major stocks. When people say the Dow is up, they're usually smiling. There are two main things that affect the price of a company's stock. One is the company's earnings. A company that makes money will likely see its stock price go up. The opposite happens if earnings are down. The other force is the investors who rely on research or history or even instinct to forecast what a company may do. A lot of analysis and thought go into these decisions, and if a lot of people become enthusiastic about a company, the stock price will increase. Let's say you want to buy some stock. You start by opening a brokerage account, either with an online site or a stockbroker who does the work for you. Either way, you pay a service fee to buy or sell stock. Online sites usually charge less but don't give you much help. A stockbroker will meet with you and give you personalized advice. Of course, this costs more. Decide how much money you have to invest and choose the stocks you want to buy. The number of shares you can afford depends on the price per share and the amount of money you have minus the brokerage fees. Because stock prices change constantly, you usually tell the broker the maximum amount you want to pay, and the broker will put in your order when the stock goes below your maximum offer. It's pretty much the same way when you sell the stock. You tell the broker to sell at the current price or to wait until the value hits a certain number. If you handle your own account online, those sites usually have the ability to sell for you at specified trigger prices.
In determining when to buy and sell a stock, The fundamental premise of buy low and sell high is ideal. Knowing when those moments arrive can be much more challenging.
There's a lot of uncertainty when it comes to investing in the stock market. Investors need to recognize that there is no one silver bullet that's going to give you the answer as to whether you should be buying the market or whether you should sell the market. It's better to have a disciplined, predetermined amount of money that you're willing to put at risk. When that number is breached, you need to continue to stay disciplined, cut your losses, and move on.
The stock market has a history of making millionaires and sometimes ruining them. Any decision about investing your money should be made carefully. Remember, this is not the place for all your money, but an excellent way to diversify, spread it around. This is also a place for long-term investing. In fact, stocks continue to outperform other forms of investments over the long haul.